Hey everyone, welcome back to the channel. Today, I want to take a couple minutes to talk about a company that I saw pop up a lot recently on the internet. On both the investing and the value investing subreddit, there's a post about if you could buy one stock and hold it for the next 100 years, what would you buy? I saw waste management listed a few times. And, I found this one interesting. So, right, I think a lot of us in the US at least have heard of waste management. They're a large, waste facility company. So I decided I'd make a video on them and kind of see what all this excitement or hype is and why all these people are recommending it. And I decided to do all this before actually looking at their current valuation and seeing what they're trading at and see kind of my reaction to that. So first thing I'll do here is let me just talk through a few things about the business, and then we'll get into a little bit of the financials and the model I pulled together. So the first thing, we'll talk about the business units. They have a collections unit, and that's basically exactly what you'd think it is. There's commercial and industrial waste collection and then residential collection. A lot of this, based off the 10K, it looks like it's about 3 to 10 year contracts for a lot of these. So, I think it's a pretty stable contracted business, not something that fluctuates super often. Next piece is landfill. They actually operate 263 solid waste landfills in the U.S. and Canada. This is the largest landfill collection or landfill management facilities in the U.S. and Canada. And then last thing, or I guess there's a couple more things actually. Sorry, transfer sites. This plays into the both landfill and collection. So if you collect the waste but you're too far from a landfill, you put it into a transfer site. At this transfer site, it's going to be compacted, packaged together with other trash, put on either a railroad or put onto a truck and then shipped over to a landfill, usually one they own, but sometimes one they don't. Another business unit they have is recycling. This is pretty interesting. It's a lot of the revenue here is driven primarily by commodity prices, which is something they're actually looking to shift. They do a lot of recycling for third parties. And historically, the way it worked is they would kind of quote, we'll pay you this amount per ton of aluminum or glass or whatever it is. But if commodity prices were fluctuating up or down, they could actually end up losing money on this. So they've switched more to a pay for service and then split the profit. So basically now you're going to pay for at least the processing cost of your recycling, and then any profit that's made, they're going to take kind of a revenue share of it. That's the model they're shifting to. So hopefully to see a little bit more stable revenue coming out of the recycling business in the coming years. And then the last piece they have is this thing, other, that they mention. It's a lot of different things. It's like specialized waste removal for like oil and gas, hazardous materials, construction remediation, a little bit of like consulting for other large companies that need to dispose of things. So, overall pretty interesting and pretty straightforward, pretty standard business, kind of exactly what I would expect. Competition, kind of thinking about this and reading through their 10K, big things here are governments and quasi-governments / private resources. So really, if you think about it, like a municipality may have their own waste collection, their own landfill that they manage. So in that situation, right, you're never going to win the contract to provide waste services unless if there's an HOA or something that chooses to go through you instead of the local municipality. And then there's also some other large waste management companies. I think Republic Services is another big one. I'm not sure if they're public or not, but I know they're a big kind of waste management company as well. Something they touch on is seasonality. I didn't even think about this from a waste management perspective, but there's definitely some seasonality in this business. The sense of this is really like in the summer months, their revenue will peak. The reason for that being is construction. So if you're demolishing a site, building a new site, anything like that, there's a lot of hauling that happens in the summer during construction months, and during those revenues peak because they handle kind of this third party collection and disposal as well, right? So if you're a third party hauler, and you need somewhere to drop it, you probably don't have a landfill, so you're going to bring it over to them. So pretty interesting there. Employees, I think they're pretty standard. 50,000 employees is what it was. I think 9,000 of them, so roughly 20% is corporate. And then about 20%, 9,000 is actually under a union. So that's kind of a big risk they mentioned as well. And kind of moving to the risks, I think there's a handful that kind of stood out to me. I think the big one is regulation here. This is a highly regulated industry, landfills, a lot of permits, a lot of just red tape to work through. So I think regulation is really one of the biggest risks with this companies. The next one is just general expansion. So what I mean by that is there's kind of two prongs, right? So to expand a landfill, you have to get necessary permits and you have to get kind of local authority and local approvals. So if those don't happen, that can make it pretty tough. So that's kind of the first part. The second part there is also once you've kind of saturated a market, this isn't exactly like a super growing industry, right? Like the amount of new businesses and new homes and new development. So you're kind of tied to the broader economic development of areas. So as areas die and new areas grow, they kind of offset, but you're kind of betting on like that general trend of continued economic development and prosperity in areas that are underdeveloped, that need a waste service. So I think it's tricky from that standpoint. So I think you see a lot of acquisitions in this space. Another one is commodity pricing, obviously, but as they're moving away from recycling, their old recycling model, hopefully commodity pricing becomes less of an issue. Natural gas pricing is also another big one. The reason for this is they've actually started to natural gasify. I don't know if that's a word, but natural gasify their truck fleet. And this is to save on fuel costs. But if natural gas becomes unavailable or more expensive, it can make it actually more cost prohibitive than traditional fuel like diesel for their fleet. Another thing is just labor costs generally increasing in labor unions. So they've already have about 9,000 of their 50,000 employees unionized. If that continues to spike up, right, you could continue to see increased costs. And then another big one, and I think this kind of ties into regulation, but climate change. So there's a lot of, just different greenhouse gases and stuff emitted at landfills and whatnot. So if kind of, in the next decade, if we really take climate change seriously, this could be something that's really scrutinized, and they would have to invest in technologies and other ways to dispose of your trash that could be more expensive. Obviously, they would probably try to pass this on to the end consumer, but if it becomes prohibitively expensive, it kind of could become something similar to a utility or something where there's it's for profit but capped profit, and there's government intervention. So I mean, I think you could see more kind of a path towards that in the future. Something interesting to note, Waste Management's actually performed really well though in the last 5-6 years. I think they've outperformed the S&P 500, it looked like. And then another interesting thing, COVID, they've tied to about a $900 million loss in revenue, which I think makes sense, less commercial business, kind of even, I think less construction, but I think construction's actually been doing pretty well. But, I could see an argument for why, revenue might be down in the last couple of years. So that's kind of a high level overview of Waste Management. Some of the things I kind of noticed when reading through the 10K. I thought it was all pretty standard, pretty straightforward. I think it's an easy business to understand, right? They come to your house, they pick up your trash, they haul it away, put it in a landfill, and charge you a little bit of money on it. They also, you can dump your trash at their landfills or at their transfer sites if you're a third party. So if you're like 1-800 got junk and you need somewhere to dump, right, you can go dump it at their site as well for a fee. So pretty straightforward business model. So with that, let's go ahead and let's hop on over into the DCF that we pulled together, and I'll walk us through that. So here's the DCF I pulled together, and a little bit different than some of my other ones. I have high-level assumptions here that you can actually kind of follow along with. But if we actually go over to the income statement, you'll see in here I actually make all my assumptions and then link this up. So a little messy, apologize for that, but everything's still there. And we'll talk through high level what I have here. Their 10K actually provides a great amount of detail, which I actually really appreciated. So on revenue, they break it out by just about, all the different divisions they have. On operating expenses, this is really their cost of goods sold is what I would classify it as their COGS. They break out their COGS by components, which is pretty rare. You don't see this very often. SG&A, they break out as well. Their D&A, they break out as well. And then their other expenses, they break out as well. So I thought it was actually really nice that they provided this much granularity for us. So if we go over to the DCF, I just went back to 2018, and I understand that in 2021, they've actually already reported 3 quarters worth of results, but I ignored those for the sake of this analysis. The reason being is, having to kind of quarterize that Q4 and drop it in gets a little messy, but really what I did here is if we look at their 2020, what I did is I adjusted this. So I took their 2019, multiplied it by the growth rate they had in 2019 to get an adjusted 2020. And from here, you can see I get about 16.1 billion compared to their 15.2 billion, which actually happened in 2020. The difference here is they actually state in their 10K that revenue is about 900 million short for 2020. So this is kind of that adjusted 2020 picture. And then the reason I did that is so I can calculate what a 2021 would look like based off historical growth rates. So that's what I did. For 2021, I calculated this. You could follow the formula here based off historical growth rates. And this gets us to about 17.3 billion in revenue for 2021. And if you actually go look at like Yahoo Finance, a lot of the analyst estimates are actually pretty much in line with this, very similar to this kind of 17 plus billion. So, instead of quarterizing, I just kind of took this approach, and we're getting kind of the same ballpark as where a lot of analysts are expecting them to end the year. So from here, you see a big spike in 2021 for growth, and this is really just making up for that lost revenue due to COVID in 2020, and then normalizing back out and actually still growing faster than they have historically in the future. We do have COGS slightly improving. The reason for this is they mentioned they're moving to a more automated trash pickup system, so moving a lot of people to bins that can be picked up by the trucks themselves and only need one worker to really operate the truck. So over time, they expect to see automation savings. I don't think it's going to be anything crazy, but we do have that declining as time goes on. SG&A, we have dropping back down to more 2019 levels. The reason for that being is just, in 2020 with revenue down, your SG&A is going to be a high percentage of it because it's a little bit more of a fixed cost. But as revenue goes back up, that SG&A will kind of drop back down. From there, we looked at CapEx and we looked at depreciation, very straightforward. CapEx, we held at about 12%, and then depreciation about 87%, which is where they were historically before 2020, which I'm going to guess they kind of stepped off the gas a little bit on CapEx just because, it's a down year. So maybe you invest a little bit less, and then depreciation is kind of picking up in comparison. So with all of this, we can use variable WACs, but, really if we look from an 8 to 10% WAC with a 3 to 3.5% perpetuity growth, you get 23 to 42 billion. In my mind, I was like, oh, wow, that's pretty good for a company that, they're operating on, their EBIT is, what is that? A little over 10%. So kind of trading at and if we look at EBITDA, in my mind, I'm thinking, okay, if we take the middle here, call it 36x EBITDA. It's like, that seems pretty good for this giant kind of industrial company. If we actually go pull up their market cap, they're actually trading at a much higher market cap. If we look here, let me go to Yahoo Finance real quick. I think they're trading, it was 70 billion. It was something that I was kind of shocked by. What is it? 68 billion, right? Which is pretty large compared to where I'm getting. So my next thought was like, okay, maybe they're being valued more as like a dividend play. So I pulled together a quick little Gordon dividend growth model. If you're not familiar with this, the way it works is you kind of predict next year's dividend, and then you divide that by the expected growth of dividend minus the expected kind of general return of the company. So in this, I pulled in historic dividends to see how the dividend growth has been going. Looks like it's been averaging down, approaching kind of 5%. So if I use 5%, it's kind of a perpetuity growth rate for dividends. And then I use the 7% WAC, which is actually pretty low. I wouldn't be happy with the 7% return, but you get $120. And I was like, that's a very nice valuation, right? If I throw a 7% in here even, you get 51 billion. 52 billion. So that you're like, okay, you're still not there. And when I kind of look at this, really what you have to be anticipating really is you're going to have to take a low WAC for the dividend model to make sense. You're going to have to take a low WAC, probably 7 or 8% with a high dividend. So you're expecting the dividend to increase back up, growing 7 or 8% a year. And just from a fundamental, if we look at here, even you'd have to be comfortable with the 6% kind of rate of return, or discount rate per se, to get to a similar valuation. So in my mind, I don't understand why this company was getting so much love. If we look at it, right, it's trading at a 40 PE for a company that's picking up trash with a lot of, it's a very unsexy business. It has a lot of regulation in place. I understand it's not easy to come in and be a competitor, but they're not going to experience hyper growth. It's just not really possible in this industry, I don't think, right? You're winning kind of one municipality at a time if you're getting new contracts. And it's pretty tough. It's mostly kind of growth through acquisition. It has a nice dividend that's been growing for a long time. So if they continue growing the dividend, that's great. But I don't, when I saw this, I was thinking a lot of people knew something I didn't, that this was like severely undervalued, or this great, just printing money, operating at like 60% margins. But, in reality, what is this? 33% margin. So nothing too crazy, I don't think, to justify a 40 PE, when I think if we look at some other kind of more attractive companies, like what's Apple's PE? Apple's trading at a lower PE than them. I'm sure Google is probably in a similar boat where much lower PE. Facebook. So, you know what I mean? There's these high growth, kind of high margin, or maybe not high growth, but I mean, they have been growing very strongly, but these high margin, tech companies that have lower PEs than this waste management company. So something just seems fundamentally off for me on this. I think it's an interesting company. I think it's a great business, and I think there's a big moat there around like being able to enter, but I think the current valuation is just severely overvalued. But I found it an interesting company to look at. So I hope you found this interesting or useful. If you have any questions or comments, feel free to leave them below, and I'll try to get back to you. Thanks so much.